Why did the rate cut cause the market to crash? The Fed misjudged again, falling into a massive credibility crisis. Rare clear warning of escalating inflation risks in 2025. Interest rates will remain stagnant long term. Last Wednesday, the Fed decided to cut interest rates by 25 basis points again. Normally, a rate cut is good news, but this time it's a bit unusual. Over the past year, the stock market, bond market, and Bitcoin all reached historical highs. And economists and analysts believed that the market had entered a bubble phase. However, after this rate cut, the market did not surge as expected, but instead plummeted. The S&P 500 index, the Nasdaq 100 index, and Bitcoin all started to decline upon the rate cut news. Could this be the start of a new market adjustment? We have seen similar phenomena of overvalued markets in 1929, 2001, and during the 2020 pandemic, where a small event triggered a sharp market downturn. This video might be the most important in the next 12 months, as I will analyze what exactly happened, what the Fed said during their rate decision meeting, and their warning for 2025, which will greatly affect your life and investments in various aspects. Before we delve into the major changes coming in 2025 and the details of the Fed's rate decision meeting to cut interest rates again, let's look at the most critical market factor. Inflation. Data released on December 11th showed that US inflation in November was 2.7% year over year. Although higher than the Fed's 2% target, it was a significant improvement from last year's 3.3%. Inflation hasn't accelerated, but remains very stubborn. According to BLS statistics, the most important factors driving price increases in November were home food prices rising by 1.6%, dining out prices by 3.6%, energy by 2.8%, and rent, which accounts for 1/3 of the CPI, increasing by 4.7% year over year in November, accounting for 40% of the total increase. This 4.7% is the smallest increase since February 2022. If the Fed keeps policies stable and slightly adjusts the data, inflation can look better and slowly decline. If you don't feel the inflation decrease is obvious enough, you must be very sensitive to stock market changes. I think someone has to speak out. 2024 was a very good year for every stock market investor, with returns far exceeding expectations for many. For everyone concerned about their investment portfolio, 2024 was the best year for the S&P 500 this century, rising over 30%. If we trace back to the 1920s, we find that the S&P 500 rising over 30% in 1 year has only happened 9 times. However, some experts warn that such high market returns of 30% in 1 year are unsustainable. Don't assume that making money this year means you'll make even more next year. How do you know this year isn't the best year for the next 5 years? Although historically, the year after a new market high often yields returns above the historical average, Warren Buffett's actions are contrary to the market, taking a more cautious approach by selling a lot of stocks. Berkshire's current cash reserves have reached an all-time high of $325 billion. So if the market is good, why is Buffett holding more cash? Actually, the Buffett Indicator can make it clear. Introduced by Buffett in 2001, this indicator measures the overall valuation of the US stock market by comparing the total output of the US economy with the total value of listed companies. When any parameter deviates from the normal range, it becomes particularly noticeable on the chart. According to Buffett, it's the best single measure of where valuations stand at any given moment. When it's at 100%, it's considered reasonable. When it's at 70%, the market is cheap, and when it approaches 200%, investing turns into speculation. As of September 30th, the Buffett Indicator reached 208%, indicating that the US market is severely overvalued, almost 2 standard deviations higher than the historical average. This makes the current market one of the most expensive since the 1950s. Historically, every time this ratio reached such heights, the market experienced a severe downturn. Actually, most analysts now have similar views, predicting that the annualized return rate of the US stock market over the next 10 years will be between 0% and 7%. JP Morgan, Goldman Sachs, and Morgan Stanley all predict that the S&P 500 will reach 6,500 points by 2025. Barclays predicts 6,600 points. Bank of America gives a strange figure of 6,666 points, and National Wealth Bank believes it could reach 7,007 points. It's hard to interpret these exact numbers. Regardless of how you view these banks and analysts' predictions, the one thing we cannot do is expect the stock market to rise sharply in 2025. Historically, good returns have only come from a few very good years, and these good years' gains offset the stock market declines in bad years. In 37% of the time, the stock market's annual return rate exceeds 20%, indicating that the so-called average return is not common. The normal market average return is just an aggregation of various extreme results. Last Wednesday, the Fed announced a 0.25% rate cut, the third in this rate cutting cycle after previous cuts of 0.25% and 0.5%. Everything seems normal, but the Fed's new plan is to slow down the pace of rate cuts. Looking at the US federal funds rate over the past 50 years, the current rate of 4.5% is not high. Interestingly, after the meeting, the Fed updated its economic forecast report for 2025. The updated data and predictions are almost entirely opposite to previous forecasts, indicating an upcoming market transformation. You can find the original economic forecast report online, but I'll highlight the key points here. On the second page, you can see the Fed's interest rate expectations for 2025. In September, they expected the rate to drop from 4.4% to 3.4%, a total decrease of 1% or 4 rate cuts. However, the December report revised this, expecting a drop from 4.4% to 3.9%, a decrease of 0.5% or only 2 rate cuts. The pace of rate cuts in 2025 will significantly slow down. Let's look at the unemployment data. Over the past 60 years, last month's unemployment rate slightly increased from 4.1% to 4.2%, giving the Fed a reason to cut rates at this meeting. But now, the Fed says their concern about the labor market is not as significant as before, so they want to slow down the rate cuts. Do you see the contradiction? I don't believe the Fed is cutting rates to help the labor market, but to save banks, commercial real estate, and the federal government's debt crisis. The Fed's communication is no longer effective because open market rates are rising, as the public expects that rate cuts will lead to a resurgence in inflation. Then a reporter asked the most critical question: will this rate cut be the last one for a long time? Powell gave the usual vague answers, saying they would take it step by step and couldn't make a decision now. If you expect another rate cut between January and March, it's unrealistic. The possibility of a rate cut in the first quarter is very low. Powell vaguely explained a very obvious contradiction, along with clearly reducing the frequency and magnitude of rate cuts and expecting inflation to rise, explaining why the S&P 500, Nasdaq 100, and Bitcoin all fell significantly. After studying the economy for so long, I really think the Fed's actions lack absolute logic. Here are my thoughts. Although historically, US stock prices are very high now, no one knows what will happen in the future or what the prices will be a year from now. I always prepare for the worst case scenario. To deal with this, I diversify my funds, investing some in the real estate market, some in index funds, and a small portion in individual stocks and cryptocurrencies. Even with significant fluctuations, it won't affect my investment portfolio and long-term returns too much. Additionally, I keep cash equivalent to 24 months of expenses for emergencies. Regardless of the stock market trend, I make regular and fixed purchases. The market is an irrational voting machine in the short term and a rational weighing machine in the long term. I prefer long-term rational investment. If you've read this far and found the video helpful, don't forget to subscribe to the channel and give it a thumbs up. This is Michael's Fortune Bread, sharing financial intelligence knowledge that you can't learn in school. I'm Michael. See you in the next video. Bye.